Welcome back to Smart Finance UK. And if you're new here, welcome to the channel. Now, let me ask you something. What would you do if you had your first $100 ready to invest today? Would you put it into one stock, keep it sitting in your bank account? Or could that $100 become the beginning of your long-term investing journey? In today's video, we're going to break it down step by step. I'll show you what a beginner should think about before investing, how diversification works, why fees matter, how consistency can help, and some of the biggest mistakes you need to avoid. And stay until the end, because they'll give you a simple framework you can use every time you invest. Before you invest your first $100, there's something much more important than choosing a stock. Make sure you actually can afford to invest it. If that $100 is needed for rent, food, essential bills, debt payments, or an emergency, investing should probably not be your first priority. Investing is generally a long-term activity. The market can rise, but it can also fall, sometimes significantly. That's why money you may need in the short term will be treated differently from money you're prepared to leave invested for years. Your financial foundation comes first. Once your essential needs are covered and you have money available for your long-term goals, then you can start thinking seriously about investing. Now let's move to step 2. Know your goal. Why are you investing? Maybe you're building retirement savings. Maybe you're saving for a future home. Maybe you want to build long-term wealth. Or maybe you simply want to learn how investing works. Your goal matters because your time horizon matters. If you may need your money in 1 or 2 years, you have a very different situation from someone who plans to invest for 20 or 30 years. Before choosing an investment, understand how long you can realistically leave that money invested. Now we come to one of the biggest lessons for a beginner. Don't confuse investing with gambling. You might see a company online and think, this stock is going to explode, so you put your entire $100 into it. If the stock performs well, you might feel like a genius, but if something goes wrong with that company, a large part of your investment could be affected. That's why diversification is so important. Instead of depending entirely on one company, some investors choose diversified funds, such as broad market index funds or ETFs. These can provide exposure to many investments through a single fund. But remember, diversification doesn't eliminate risk, and the exact investment products available to you depend on your country and circumstances. Always understand what you're buying before you invest. Here's something beginners often overlook: investment fees. Imagine 2 investments that have similar performance. One has low costs, the other has higher ongoing fees. The difference might look tiny at first, but when you're investing for many years, those costs can reduce your overall returns. So before investing, check the fees. Look at fund expenses, platform fees, trading costs, and any other charges that apply. Don't simply choose an investment because someone on social media says it's the best. Understand what you're paying for. Here's another trap that catches beginners. They spend all their time trying to find the perfect moment to invest. Should I buy today? Should I wait for the market to fall? What if prices drop next week? Nobody can consistently predict exactly what the market will do next. That's why many long-term investors focus less on predicting short-term movements and more on following a consistent strategy, depending on your circumstances. Regularly investing an amount you can afford may help you build discipline over time. The goal isn't to predict every market move. The goal is to build a strategy actually stick with. Now let's talk about one of the most powerful concepts in long-term investing: compounding. Imagine you invest money and it generates a return. If those returns remain invested, future growth can potentially build on previous growth. This is why starting early can be powerful. Your first $100 isn't important because $100 will suddenly make you wealthy. It's important because it can help you develop the habit of investing. And when that habit continues for years, even relatively small contributions can become meaningful over time. Of course, There are no guaranteed returns. Markets can fall as well as rise, but time and consistency are two concepts every beginner investor should understand. Now you might be thinking, what about Bitcoin or cryptocurrency? Crypto has become a major part of the financial conversation, but it can also be extremely volatile. Prices can move dramatically in a short period of time. That doesn't mean every cryptocurrency investment is automatically bad, but it does mean you need to understand the risk. Your first $100 shouldn't be about trying to turn a small amount into thousands of dollars overnight. Investing is about building wealth responsibly, not chasing quick money. So, let's put everything together. If you're ready to invest your first $100, here's a simple framework to think about. Number 1. Make sure you don't need that money for essential expenses. Number 2. Define your investment goal and time horizon. Number 3. Research diversified investment options that are available in your country. Number 4. Compare the fees. Number 5. Understand the risks before you buy. And number 6. Decide how much you can realistically invest on a regular basis. Remember, the goal isn't to find a magic stock. The goal is to create a repeatable financial habit. And now, one of the biggest mistakes I want you to avoid: checking your investment every 5 minutes. The market moves every day. Some days you'll see green, other days you'll see red. If you're investing for the long term, reacting emotionally to every small movement can lead to poor decisions. Instead, focus on your original goal. Focus on your time horizon. Focus on your risk level. And most importantly, don't invest based purely on what someone on TikTok, YouTube, or social media tells you. Do your own research. Here's the most important thing I want you to remember. Your first $100 isn't about becoming rich. It's about becoming an investor. The first investment teaches you how the market works. The next investment teaches you consistency. And over time, that consistency can become more valuable than the amount you started with. You don't need to start with thousands. You don't need to predict the market perfectly. And you definitely don't need to chase every trending investment. Start small, learn continuously, manage your risk, and think in years, not days. If this video helped you understand investing a little better, hit the like button and subscribe to Smart Finance UK. And I want to know something from you. Would you invest your first $100 or save it? Comment invest or save below. And if you want more simple, practical finance videos without the complicated jargon, make sure you're subscribed. I'll see you in the next video.